Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of October the 27th, 2025. Now, to get started this week, we'll begin where we always do with that very important dollar bull fund. Now, what I've generally moved over to is the Wisdom Tree Bloomberg US Dollar Bull Fund. I believe it to be more relevant than the DXY because it's not heavily trade weighted specifically to the euro currency. I want a broader range. So I've been talking about this one over the last few weeks, showing examples of it, but I think we can move forward with it alone. So right now, as we can see, there is a medium-term diff cross that's attempting to go back to the upside, but it's failing. So right now we have two verified resistance highs that's coming in at or about 26.81. For the dollar to remain bullish, we would need to break free and clear of that particular area. And right now, the core VP indicators are warning there's potentially a problem here. So we've had a retracement. We couldn't break down. We had a false signal in the MA diff cross, the medium term crossover. But this is why we always use the T cross long as our core way of measuring whether something is bullish or bearish, or if a trend is actually going to change. So in this particular scenario, we would need to break down and close below the T cross long 2 days in a row in order to confirm that we're reversing lower. So that respectfully, that's what we should be looking for this week. The T-cross long coming in at 26.64. We break down, close below that level. That would confirm some type of dollar weakness. Now, if I were, again, to apply the same thing to the standard UUP, which mirrors the DXY, where USDU does not, the indicators here are a little bit more bearish on this side. So if we look at combining both of them, the signal, excuse me, is very similar, but it definitely isn't the same, and that's what we want to look for. And again, we also measure that based around the calendar yearly opening price. And as you can see, both the UUP and the USDU are below their respective calendar yearly opening prices, still bearish on the year. And again, the dollar usually does very good in its fiscal fourth quarter, but that ended October 1st. So in my respectful opinion only, the dollar could come under some pressure in the days and weeks ahead. When we do that comparative analysis to gold, we can see that gold has had a relatively significant failure at the high, 43.81. And I will point out on Monday on last week, the media was really pushing for longs on Bitcoin, or excuse me, longs on gold, saying that Bitcoin is not cut up to the performance of gold. That was not factual. And again, sort of pushing everybody towards gold in the beginning of the week, only for it to tank. So for the gold buyers, well, the good news is that we're holding. We've come down, had three retracements, excuse me, three tests of the T-cross long, Wednesday, Thursday, and Friday, and we have failed on all three. So when we look at the primary trend of the US dollar, it's down. We look at the primary trend of gold contracts, it's up, and that's measured off the yearly performance. The year-to-date performance, gold is still very bullish on the year, where the dollar is not. So this would tell me that gold potentially is getting ready to turn back to the upside after we've had this minor corrective move. Now again, we want to be careful of a potential false signal on the medium-term crossover. We want to always combine that with the T-cross long, and as you can see, we are not closing below the T-cross long. That invalidates the medium-term crossover, in my respectful opinion only. So when they're both in agreement, then I will consider biting on shorts on gold. But right now, I believe longs are actually still in play. When we do that comparative analysis to Bitcoin, once again, Bitcoin continues to climb, and it did so right after they told us on Monday of this past week, no, Bitcoin is not keeping up. Bitcoin's not bullish. Gold is. Well, the exact opposite happens. Bitcoin goes higher, gold goes lower. So right now, you can see that we have three tests of the T-cross long, and in my respectful opinion only, both gold and Bitcoin can break out to the upside along with the equity markets if the dollar tanks. So right now, I believe we can potentially push through this T-cross long at 111,787. If we can do that, the level you've got to keep your eye on is 114,631. That's the quarterly opening price. Uh, Putting another, again, an alternative strategy here is to put buy stops just above that number. And if it breaks above it, chances are it's going to return to the 126 area very, very quickly. So just a little heads up there. Because again, this is an outlook, not a recap of something that's already taken place. We're forward thinking here in this AI market outlook. We have an MA diff cross that continues to support longs on Bitcoin. A very significant risk off scenario could change that. I have no control over fundamentals, but currently Bitcoin is still looking relatively bullish. It's still positive on the calendar year, but I would be far more comfortable if we can get above 114,631. Now, when we look at the equity markets again going into next week, it just seems impossible to kill the stock market no matter no matter what happens with the current global wars that are going on. We've got a number of different things with trade tariffs. Stocks continue to move higher. I don't know if they can continue to keep doing this, but as long as Vantage Point continues to forecast them higher, I am going to buy them. So for now, we have an MA diff cross that has taken place over here. That was back on October the 17th. Both the medium and the long-term predicted difference have moved above the zero line, and we have momentum building on the predicted RSI. And when most people are looking to say something is oversold, or excuse me, overbought, that's usually the best time to buy it, guys. Conventional overbought and oversold tools simply don't cut it these days. We're in a momentum-based market, so we want to always look to see where there's momentum. And it would appear at first glance that there is some upward momentum building on the equities yet again. I would like to see things settle down with these trade tariffs, but I don't think that's going to happen anytime soon. So I'm not going to pay much attention to it and trade what I can see on these particular charts, along with, of course, the core VP indicators. Now, oil has rebounded a little bit here, but again, the question is how far can it rebound? This is largely based on the sanctions put on Russia from the US. I believe that this is just nothing more than a retracement on oil, and we're likely to turn right back down again. But there is one positive here. We've turned positive on the quarter. Now, if we can stay above that monthly and quarterly opening price at 72.65, we may have a longer term trade here, but in my respectful opinion, it's very unlikely at this time of year. Most traders will gravitate towards natural gas because it's a simple supply and demand issue. We just need the weather getting colder, and nat gas should start to take off. The inventories have built up a little bit. I'll concede that point for sure. But again, we will see where this goes. But for now, there's usually very little demand for oil in October, November. Now, when we look at the European equity markets, specifically the DAX, the global X ETF, running basically dead flat here. So I believe the next trigger for this is going to be the ECB on Thursday. And of course, the Federal Reserve, I believe, on Wednesday. So there's a couple of central banks speaking this coming week. I think it's pretty much baked in that the Fed's going to cut. The ECB, a little less clear on what their move is going to be, but what I can tell you, what the charts look like on a Sunday afternoon before the markets open, is the neural index strength is positive. We have an MA diff cross that has occurred here. That was on October the 17th. We do have a medium-term crossover, and we're above the 50 on the predicted RSI, saying there is no downward momentum. So I believe potentially there is a long trade here. And if the ECB is talking more cuts, that should boost the DAX higher. That's the play I would look for. But I will also concede we need to get moving on this very quickly here, or the risk of a sell-off, is still there. Now, as we look at some of our main Forex pairs again this week, all eyes will be on Euro US. It's rebounded slightly this week, but still structurally weak on a quarterly basis. Now, that quarterly opening price, 117.34, that's the area to keep your eye on. If we can break above that, the euro can push higher, but the indicators in VP are basically neutral to slightly bullish. So whatever the Fed does, I believe the ECB could counter that. So you get a dovish Fed, no, then the ECB is going to turn dovish also, because let's face it, Europe is relying on tourism. They can't have a strong euro currency, that would kill tourism, and they've done very well in the last 4 or 5 years, even attracting American visitors vacationing there. So again, we'll keep an eye on this, but there's a slight bullish uh, feel to this, but we need that fundamental of the ECB and the Fed later in the week. I think we go sideways until then with a very, very slight bullish momentum. Now, with US Swiss franc, once again, it is correlated positively inversely to the equity markets. So if the equity markets turn higher, that could put some downward pressure, yeah, again, excuse me, some upward pressure on US Swiss franc. But again, there's so many things that are risk off in the market these days. And it's hard to believe, but the VP indicators here are actually bullish. We have an MA diff cross that's occurring. That is corrective in nature until we clear the T cross long at 79.65, but there very well could be a long trade here. And my only concern is that the neural index and the neural index strength are not in agreement currently. So the defining part of this trade is if we can break the T cross long at 79.65 and the monthly opening price, quarterly opening price at the exact same level. So the more savvy trader, again, I always like to give something to the bulls and the bears and keep it neutral. If you're a bull, then you put a buy stop above 79.70, and if you're a bear, then you sell into 79.65. But either way, as long as you know your levels, this basically fundamentals move the market, guys. Two central banks that are going to move this currency also. Now, the British pound going into next week, again, still a US dollar trade. We've come up this past week up to the, again, the new quarterly opening price, that 134.45, failing yet again. So again, we want to make sure that we're objective in our thinking and saying, okay, I'm okay with going long, but I need to do that above the Vantage Point T cross long, or I need a specific targeted area. That lower area, 132.49, the newly formed verified zone, that will likely be a target for the immediate start of the week. The question is, can it break down below it? We do have an MA diff cross here too, and that is to the downside. We do have momentum on the predicted RSI. Just keep an eye on that area right there, 132.49. I don't believe we'll break that until we know what the Fed's plan is. And once we have that, that will likely be your defining moment. Now, the dollar yen, once again, the dollar yen trying to push higher. Uh, my view remains the same. The interest rate differential between the Bank of Japan and the Fed will change, and it will slowly start to favor the yen, but that's going to take some time here and multiple rate cuts. So I don't think the carry trade's falling apart just yet, but once again, the immediate resistance for next week, 153.27. There's a lot more going on around this area, guys, that I can ever say in this video, but there is resistance there. So we'll see how the market reacts to that. But again, we're trying to remain as neutral as I can. I still can't believe that this pair has returned back into the above 150, but it has, right? And that's why we don't want to necessarily try and pick tops and bottoms, just identify them and then apply fundamentals to it. So right now, the dollar yen, to start the week at least, is bullish, but I don't think the trade deals between China and the US are going to go well. I think they're starting to fall apart again. So we'll see how that goes. But for right now, we've had a retracement back to our T cross long. We're extending higher. But either way, I don't see the dollar yen breaking through 157.28 in 2025. Maybe in 2026, but I don't think so. I think this is probably we're in the final rally of this particular pair, and we'll slowly start grinding lower. Remember pre-COVID, guys, this pair Bank of Japan verbal intervention. They're going to protect the 100 level. It was hovering around the 105, 108 area. That's where this currency spends most of its time, currency pair, excuse me. So we'll keep an eye on it and check on it on a week-to-week basis. And that's why this is a weekly outlook, not a day-to-day one. Now, when we look at US Canada, this pair is falling apart again, thanks to the provincial government this time in Canada running what is considered inappropriate ads about the tariffs. And again, that was not issued federally, that was done with a provincial leader in Canada and Ontario specifically. So Trump has not taken that well. And now he's saying that all trade negotiations are off. So once again, this does not favor the Canadian dollar. The key levels for next week will remain at the monthly opening price here. That's coming in at 139.20 and our T-cross long at 139.90. Even with oil prices moving higher last week, it didn't really do much to help the Canadian dollar. We got a retracement back to our T-cross long. This is the area to keep your eye on, but the monthly opening price would be another very good buying opportunity because I don't see any kind of trade deal coming between Canada and the US. So again, we have a medium-term crossover to the downside, but just a little side lesson here, guys, for new people using Vantage Point. We need to only take a short on that medium-term crossover if we're below the T-cross long. It's okay to short it up here, but if you're not closing below that T-cross long, it invalidates that medium-term crossover. We always want to make sure we're using them together. And as you can see, the predicted RSI is in direct conflict of that medium-term crossover. When I see something is oversold, I won't buy it when it's here. I'll buy it when it rises and goes above the 50 mark. I believe that will be Monday and Tuesday because now it's very clear any trade deal between Canada and the US is unlikely at the current time. Now, for the Aussie and the Kiwi, they did have a bit of a rebound last week and they're still in progress. Now, again, my view is if there is a deal between the US and China on the trade side, then the Aussie and the Kiwi will both benefit from that. And I believe that both of the currencies, the Kiwi and the Aussie, are grossly undervalued. Remember pre-COVID here, guys, we were trading this thing above parity. So if you're not a Forex trader, just think, even if each 1/100th of a cent is even worth a lowly $1, if it goes from 64 up to $1, that's a lot of money. So on a very low cost trade. So keep an eye on our T-cross long, but don't let anybody tell you differently here, guys. The Aussie remains positive on the calendar year. 61.89 is where we opened up 2025. When you want to measure true performance, it can never be done commingling months or rolling performance models. We measure it from where we are in the calendar year. And the simple answer on that, where are we? We're up 5.2%. The Aussie is up 5.2% against the US dollar. That's fact, not fiction, guys. And each week I hear some analysts saying, oh, the Aussie's in a big downtrend. No, it's not. How are you coming up with that? Where did you get that from? Right? So what they'll do is they'll cherry pick highs or lows and measure the performance off that. Well, that's certainly nothing wrong with doing that, providing you understand what the primary trend really is. And for now, yes, we're below our T-cross long and we're correcting lower in an uptrend. When we look at the Kiwi, the Kiwi is really, in my opinion, taking a beating here unnecessarily, all based around interest rates cuts from the Bank of New Zealand. So if that's the case now, then it could very well be the dollar's turn to take a hit because clearly the Fed is going to cut probably more than once before January 2026. So we'll keep an eye on this, but for now, the Kiwi is trapped between 57.94, the quarterly opening price, and the yearly opening price at 56.02. Ultimately, before year end, I can see 57.94 breaking. I potentially could see it breaking the latter part of this week or next. So there's a lot of stuff going on here. We do have a medium term, an MA diff cross that occurred also on the 17th. But once again, we have to use that medium term crossover with the T cross long. Okay, that's when a trend shifts. Right now, I will concede the near-term trend is still down well below the T-cross long and the current quarterly opening, but I also think that that's about to change in the days and weeks ahead. So with that said, this is the VantagePoint AI Market Outlook for the week of October the 27th, 2025.